Let's finish up our discussion of automobile and housing transactions by talking about how to finance housing transactions. So that's typically through a mortgage. Some people pay cash, but these are pretty large transactions, so that's not the norm. So the norm would be a mortgage loan, and you can get a mortgage loan from a commercial bank that we've talked about already, a thrift institution, a mortgage bank, or through a mortgage broker. And so there are different types of mortgage loans. You can have a fixed rate mortgage where your interest rate stays the same throughout the life of the loan. That's very safe if you know that you're going to stay in the home for 30 years or more, or the term of your mortgage or longer. But the taxes and insurance are not fixed because those aren't determined by the lender. So your payment can increase, but not the portion that goes to, or not the portion that goes to principal and interest. So other types of mortgage loans would be, besides a fixed, would be an adjustable rate mortgage where the interest rate would vary over time, so the monthly payment that goes toward principal and interest could also vary. And so this could result in negative amortization. What features an ARM, or adjustable rate mortgage is sometimes called an ARM, the features that they provide is an adjustment period that kind of dictates how these interest rate changes can occur. An index rate, so the interest rate would change relative to some index, and some other features that would be specific to that loan, such as margin, interest rate caps, so the highest the interest rate could climb to, and payment caps, the highest payment that you could have. Now, I mentioned that an ARM could result in negative amortization. What that is that if your monthly loan payment is lower than the monthly interest, then the principal that you owe could actually increase instead of decrease. So your amortization on your loan should result in a portion of your loan payment going towards principal and a portion going towards interest. But if you've got an adjustable mortgage where the interest rate is increasing, it may be that, and you've got a payment cap, it may be that that payment cap is such that the maximum payment you can pay only covers the interest, or maybe the maximum interest allowable. And so in that case, none of your payment is going towards principal, and that's how you end up with negative amortization. Some other types of adjustable rate mortgages, a convertible, where that ARM could convert to a fixed rate mortgage, or a two-step ARM, where you have two interest rates, one for the first 5 to 7 years and then a higher one for the rest of the loan period. Some other mortgage payment options, interest only, those are usually short term where you're not paying anything towards principal, and so that's not something that is the norm. It's typically in special situations. Graduated payments, where your payment is slowly getting higher over time as your income is increasing perhaps. Growing equity, where the equity in your home is growing over time. Shared appreciation, where maybe you have another party that is helping you with the upfront costs, and in exchange some of the gains in appreciation on the home accrue to that other party. So again, most of these are not your typical mortgages. Biweekly mortgages that dictate your payment schedule, and then buy downs. So a conventional mortgage is one where the lender assumes all risk of loss. And so in that case, this is when you're putting 20% or more down as a down payment. And if you pay lower than 20% down, that's where that PMI, that private mortgage insurance, would typically kick in. Now, an FHA mortgage is very common. What that means is that the payments are insured by the Federal Housing Administration, the FHA. And so that allows the borrower, the home buyer, to have a lower down payment because of that insurance and lower interest rates and closing costs. So remember, we said that down payments typically are 5 to 20%. An FHA mortgage would allow you to get your down payment in that 5% range, although you would still likely have to pay PMI. A VA loan is another common type of guaranteed loan for veterans that's guaranteed through the Veterans Administration, and you can only get it one time. I believe there could be exceptions, but for most folks, you can only get one VA loan in your lifetime, and there's no down payment. Now, sometimes it makes sense to refinance a mortgage, especially if you can lower your interest rate and therefore reduce your monthly payment. But you have to look at the cost of refinancing versus that value and if it's really worth it. But it could reduce your total cost of borrowing if that reduction in the interest rate and therefore your payments and what you're paying in interest goes down significantly. So just because the interest rate goes down, though, doesn't mean it's a good idea, because you might have a lot of upfront costs that kind of take away from the savings. And so those are those closing costs that I was talking about. So here's an analysis that you can do to figure out if it makes sense to refinance. So you put in your current monthly payment and then what the new monthly payment would be, and you figure out what your monthly savings would be. That's the difference between the current payment and the new payment. And then what the tax savings or the tax on the savings would be, because remember, the your mortgage payment or the interest portion of your mortgage payment gives you a bit of a tax break. So if that interest goes down, then your tax break goes down. So we have to figure out the tax that we would incur on that savings. So we're really only saving that after-tax portion. And then we have to factor in, as I was mentioning before, the cost to refinance. Are there any prepayment penalties? That's typically pretty rare these days. Are there any closing costs for the loan? Now that should be common. So now if you take the monthly savings and the total cost of refinancing, this worksheet will give you the number of months it's going to take to break even, because that's going to be your total refinancing cost divided by your monthly savings. So in this particular case, it's going to take you more than 2 years to see the benefit. If you've got 30 years left on the loan, maybe that makes sense.